All right, everybody. Welcome back to our next tutorial. If you viewed the previous workshop, you saw that we were doing a brief presentation on how to calculate pip value in your account so that you have a better understanding of what you're making and losing when you buy and sell into different currency pairs. So we're going to go through some exercises, not only to rehash what we learned earlier, but also to go through some other ins and outs when it comes to pip value and how it works should you have a currency account that's denominated in your home currency, if you will. Like, we'll use an example because I know I have quite a few customers and students that live in Australia. We'll use an example for somebody that lives in Australia. So let's go through this again, and we'll go through a couple of different exercises on direct rate, indirect rate, and cross rate transactions and do them live. We'll start off with direct rate, which is actually pretty simple, which is taken by lot size times tick size equals the pip value. So if we were to look at the different currencies right now, which are very volatile on the taping of this, we'll take a look at the euro dollar first. And let's just go by the current asking price of the euro dollar, which is 1.11518. So I'm going to pull this up as an example. So our example will be at 1.11518. And let's say that we sell the euro dollar at 1.11, we'll just call it 718. We'll just say we made 20 pips. What is the total profit? In this case, because it's direct rate transaction, let's say we buy one micro lot on this Euro USD pair. If we did want to execute that, what a micro lot would look like, and we won't get it at the exact price. If we put in a new order, on a standardized account, it would be 0.01. This is on the MetaTrader 4 platform. You click on buy for 0.01, and that would put you into what we call a micro lot at 0.01. So the pip value is actually very simple on this, because the pip value is taken, we did a micro lot, so we're controlling 1,000 units of currency. We're doing the Euro USD, so 0.0001 is the tick size, or pip size, if you will, and that's 10 cents per pip for micro lots. So if we made 20 pips on the trade times 10 cents, that would come out to $2 profit. Pretty straightforward on that, because it's a direct rate transaction and the pip values generally do not change. If we had traded a standard lot on this, it would have been $10 per pip, so it would have been $200. If it was a mini lot, it would have been $20, so it would have been $1 per pip. So again, the direct rate transaction's not too difficult to understand. Let's go into a different one though, and let's go to an indirect rate transaction, which is lot size times tick size divided by the current rate, or you could also call it the opening rate. And we'll do an example to buy. Let's do one standard lot of dollar-yen. So again, if we did a standard lot on the dollar-yen, and I really do hope this is a demo account. Okay, good. So let's do dollar-yen. Another thing that you can do to place trades is, and we'll get into more of the trading aspect of things in further tutorials, but let's click on the asking price on dollar-yen. We'll just double click over here in our market watch, and if we want to do a standard lot, it would be 1 under the volume. So let's just buy a standard lot, 113, let's say 113.380 was our opening price. Now technically you're going to want to know exactly what your price is or what your pip value is before you place a trade. But in this case, we're just doing this for the exercise of being able to calculate. So we got this at 113.380. And let's say we close it out at 113 point, and we'll just say 685. That would be 30.5 pips. What is the total profit? So in this case, we have to take it a little bit of a step further. We would take lot size, which is 100,000, times tick size. Now, what represents a full pip on the dollar yen? We went over this during it's not the fourth decimal place, it's actually the second decimal place. So that comes to 0.01. That represents a full pip of movement on the dollar yen. And I just want to make sure I got my calculator here to do the division on this as far as the pip value goes, because sometimes you do need a calculator in Forex trading. So that comes to 1,000. So you might be thinking to yourself, whoa, we're making or losing $1,000. No, you would take that 1,000 and you would divide it by the opening rate, which is 113.380, and that would come to, calculator time, $8.819. In this case, they would probably round this to 882, the total pip value in dollars. So that's where we would stand with our pip value on trading the dollar yen at approximately 882 for the pip value. If you were trading a mini lot, it would be 88 cents. A micro lot, they'd probably round it to 9 cents, depending on the brokerage. Some brokers might just round it down to 8 cents. They all treat the rounding differently when it comes to the pip values. All right. So in this case, we've made 30. If we wanted to know how much we made on the trade, we'd take 30.5 pips of profit times 8.82, and that would come to 8.82 times 30.5, 269.01 profit on that trade. So again, when you buy or sell the yen, you're actually, I have to remind students of this sometimes when we're going through our trades, because sometimes we might have a 50 pip stop, or which is an order that takes you out of your trade as it moves against you. We may have a 50 pip stop on the yen sometimes, and people might think that that's like $50 or 50 whatever it would be, or $5 on a micro account. They're assuming standard lots or direct rate transactions. However, when we're trading indirect rate transactions, the risk is actually a little bit less per point on the dollar yen pairs, and on all the yen pairs actually, than they are on just the dollar pairs. And it all really depends on what the exchange rate is, and that tells you what your pip value is. And then for a cross rate transaction, this is where it gets a little bit complicated. Lot size times tick size times base currency, quote to you in US dollars, divided by the current rate or opening rate. So an example here, let's just see here. Let's go for the euro pound. We'll do another example with the euro pound. The euro pound is at 0.77950. And let's do a mini lot. mini lot of Euro GBP at 0.77950, and the current asking price on the euro dollar is 1.11400. Which it makes it pretty easy. And let's say we were to sell it at points. Let's say we lost on this one. Let's say we lost 0.77. Let's say we lost 50 pips. So we'll say 450 is our selling price. What is our loss? Well, in this case, we start off the same way. Lot size times tick size, 0.0001. And that comes to 10. Wait, sorry. Lot size times tick size on a mini lot actually comes to 1. Sorry. See, I can't even do simple just moving the decimal place over. So that comes to 1. And then what we need to do is we need to take that 1 and multiply it times the Euro US. We need to put this into dollars. We need to convert those euros into dollars. So the current exchange rate, so 1.11400, and then we take that 1.11400 and we would divide it by the current rate, 0.77950, and that would bring us to 1.11400 divided by 0.77950, so 1.429, or that would probably come out to $1.43 for pip value. Remember, we're trading a mini lot on this. So if we lost 50 pips, times a pip value of 143, this is where I like to use this as an example here, times 1.43 times 50, that would be $71.50 total loss on that trade. Now, before we go into other examples here, I just want to pause right here. This is Euro Pound. There's always going to be other exceptions here of other currencies and cross-rate currencies and even exotic currencies where you can have these higher or lower pip values. Just remember that this is one of the reasons why we go through this, is because there's a lot of people out there that will make assumptions. They'll just assume when they trade a micro lot they're making or losing $1 per pip. Or they'll assume on standard lots that they're making or losing $10, or on micro lots 10 cents. But in this case, it's very important to know this, because if you were trading Euro Pound here and you thought you're only making or losing $1 per pip, it's actually much different. You may have thought you only lost 50 bucks on this trade, but you actually lost $71. So you lost quite a bit more than you thought you did, and that's why it's so much. It's so important to have a firm understanding on how these work. When you trade the market, as much as me and my students do, we always have, we're pretty, this isn't something to where you have to spend 5 or 10 minutes calculating these things before a trade, before you get in. When you do this on a day-by-day basis, you always have a pretty good idea of how these things work. Now, let's get into a little bit here and we won't go through as much detail, but the other question that I get, in fact, let me state this real quick while we're in this live exercise. The other, I used to work in London, for example. There are other types of trading and platforms in the Forex market to where you don't have to worry about anything when it comes to pip value. For example, I used to work in London, so I used to deal with a lot of spread bettors. And in a spread betting account, it's not necessarily what we call a spot Forex account, where you're betting on currencies either going up or going down. In those accounts, you could either bet 1 quid, 10 pence per pip, 10 quid per pip. You can actually state, and it's usually more standardized to where you're making or losing 1 quid or whatever it might be, or £1, if you will, or 10 pence. So like spread betting accounts, different types of platforms. What we're talking about here is the spot Forex market. That's when you buy and sell here. You are actually controlling currency. When you buy Euro USD, you're exchanging dollars into euros, and you're controlling that amount at that exchange rate. And so the other example I wanted to show you here is is for non-US dollar accounts. It's going to work very similar. We won't go through all the calculations, but it's going to work very similar to how it does up here. But if you live in Australia, you're not in your account when you deposit money, you're not depositing US dollars into your account. You're depositing Australian dollars into your account. So the direct rate, indirect rate, and cross rate transactions are going to differ a little bit. All you have to do is, if you look up here on the top, you see direct rate pairs where the US dollar is the quote currency. Indirect rate pairs where US dollar is the base currency, and cross pairs are pairs where the US dollar is neither base nor quote currency. All you have to do is take out US dollar on all of these different scenarios and replace it with Aussie dollar. It's really as simple as that. For example, direct rate transaction are pairs where the Aussie dollar is the quote currency. Indirect rate transactions are pairs where the Aussie dollar is the base currency. And our cross rate transaction, those are pairs where Aussie is neither the base nor the quote. Remember, we are dealing in exchange rate here. So let's say you're trading a direct rate pair. Like in this case, a direct rate pair would be like the Euro-Aussie pair. The Euro-Aussie pair, if you trade that, you see it's at 1.49640. Like if you buy EUR AUD, what is the pip value? And let's just deal in standard lots. Well, lot size times tick size. Trading 100,000 times 0.001. So it would be 10 AUD per pip on the Euro-Aussie pair. Now for me, the Aussie dollar pair is a direct rate transaction for me. However, if you live over there, if I were to buy, and we'll stick with standard lots here, if I were to buy one standard lot of AUD USD and I live in Australia, what is the pip value? Well, it's still lot size times tick size, so lot size, tick size, it's 1 pip, and that would come out to 10. But then we have to take that 10, and let's see, where's Aussie dollar at? 0.74452, we'll call it 0.74450 divided by 0.74450, which is the opening price. I guess we should put that up here. So what is the pip value going to be here? Well, back to the calculator here. 10 divided by 0.74450. So in your case, when you're trading Aussie USD, your pip value is 1343 Aussie when you're trading the Aussie US dollar pair, because for you, that's an indirect rate transaction. If you live in Australia and you keep your account denominated in Australian dollars. Why? Because when you're making profits and losses, your broker is converting all this P&L all these pip movements along with pip values back into Australian dollars. I mean, when you open an account in Aussies, you're controlling actual U.S. dollars and euros and pounds and the exchange rate between those currencies. And then once it, when it's being swept into your margin account or into your profit and losses for your gains or losses in your trading capital, it's being converted back to Aussie dollars. And so that's, these are kind of the back end transactions that are being done to ensure that your account is reflecting your profits and losses in your home currency or in your account denominated currency. Another example of this would be the, like if I buy, it should come out the same, but I'll do it anyway. If you were to buy one standard lot of Euro USD at 0.11464, $1.11464, what is the pip value? And this would be the same if you lived in Great Britain, Euro. All you're doing is you're changing Aussie to euros or pounds if you have a spot Forex account in any one of those denominated currencies. So same thing. I know I'm kind of a creature of habit, so we'll go through that again. That's $10. Now the Euro Aussie, let's say we bought this at the same time. Here's a Euro Aussie pair right up in here. Where is the Euro Aussie pair trading at actually? 1.49980. $1.49980. So lot size times tick size. You take that 10 times 1, you convert the base currency back into Aussie dollars, 1.49980, so that would come to 14.998, or basically 15. You can round it up if you want. You would take that 15 on that and divide it by 1.11464, which is the current asking price. So 15 divided by 1.11464 comes to 13.457, or that's going to be roughly 13.46. They've moved a couple of pips, so it's roughly going to be the same as the Aussie US dollar pair. Pretty much all the dollar pairs where the dollar is the quote currency, but there are going to be some, like if you were to calculate euro pound is also a cross rate transaction in Aussie. That's where it might change a little bit. If you're an Aussie dollar trader, that's where you're gonna see the same thing we do here in the U.S. With the Aussie dollar, with the euro pound exchange rate. But once again, these are all your transactions that are done in order to, essentially make it possible for you to have an idea or understanding when you get into a trade of exactly how much your risk is, and on the flip side of that, how much your reward potential is. And no, it may seem complicated, but for example, in the NurreFX classes, if you live here in the U.S., we trade Euro USD, Pound USD a lot. A lot of the time, you don't have to really worry too much because, for one thing, there's calculations. The brokerage platform does all the P&L for you, and as you do this over and over again, you have a solid understanding, really, of what your pip values are, as you become more accustomed to trading every day in the FX markets. So with that being said, we're going to go ahead and I'll explain what our next tutorial is going to be. Remember, we're trying to get you in a place where you kind of understand all the foundations of this, where all these numbers come from in your account when you open it before you even place a trade. So the next tutorial we're going to do is going to be on margin and leverage. Now that we've understood what an exchange rate is, what a pip is, how much those pips are worth as they fluctuate up and down, the next tutorial is going to go over how much do we have to put up on our trades in order to hold these transactions. And that's where we're going to get into margin and leverage. So I want to thank you for watching this little exercise on calculating pips. I hope it was enjoyable, and I will see you in the next tutorial on margin and leverage. Thank you for coming in, folks.